Buckle up, everyone. You are strapped in and ready for the Insurance Hour with me, your host, Karl Susman, informing, educating, and entertaining Californians one policy at a time. This is Insurance Hour. Hello, and welcome to Insurance Hour. I am your host, Karl Susman. Thank you so much for being here today. If you have any questions, feel free to reach out. You can call us at 559-656-0317. You can also send any questions you have to questions@insurancehour.com. If you need help right away, you can also dial pound 250 on your cell phone, use the keyword insurance, and you will be routed to, hopefully, an agent right away that can help you. Today, I am thrilled to have a guest with us that is going to provide us with more information than you can possibly imagine and hopefully dispel an awful lot of rumors. I have with us Benjamin McKay. He is the CEO and Executive Director of the Surplus Lines Association of California. He has a career in both public and private sectors, expertise in insurance, regulatory affairs, legislative affairs. He has been instrumental in shaping the surplus lines market in California, being sure that the needs of consumers and businesses are handled. I don't want to I mean, I can sing your praises indefinitely, but I want to first just welcome you so much for being here with us today.
Thank you, Karl. Pleasure to be here.
We have an unbelievable change and shift in the insurance industry in California, as you and I certainly know. Yeah. And if people are tuned in, they're probably aware of it as well. So before we get into the nuts and bolts of it, in your own words, can you describe briefly what does surplus lines insurance mean, and how does it differ from, I suppose, standard insurance, if you want to call it that?
Yeah, standard's a good term, in fact. For what is also known as admitted insurance. I usually look at the insurance world and I divide it into three parts. You have life insurance, you have health insurance, and you have P&C, property casualty insurance. So that's all your stuff, your house, your building. That's what we are. We're the property and casualty insurance. It's also liability. Someone falls down at your business and gets hurt, that sort of thing. But I think life and health are pretty self-explanatory. People understand those. It's this P&C part that's a little tricky. And then P&C can be further divided into standard or admitted and non-admitted and government programs, like, for instance, the FAIR Plan or the California Earthquake Authority. And so if you put those three together, that's the whole property and casualty pie. Standard, surplus lines, government. And there's other kind of really weird ones if we want to get crazy, like self-insurance and captives and things like that. But we'll avoid those because they're a very specialized small part. What the big parts, the parts that matter, I'm sure to your listeners, are admitted, also called standard, surplus lines, and government. And I should warn before we get too far along, I'm going to re-say words a lot because the language of insurance is so utterly confusing. We use the same word to mean three different things and three words to mean the same thing. So I've created this habit of saying, when I mean agent, I mean retail agent. When I say broker, I mean surplus,
Absolutely. You know what? The more of that, the better, because I want everyone to have a chance to try and understand it. And context clues don't always work for this stuff.
Right, exactly.
So when we're talking about surplus lines,
yes,
that means, is that equivalent to a non-admitted carrier? Are those fairly synonymous terms to use?
They are. They're synonymous. The only reason we use non-admitted, we don't like that term because it sounds like, oh, you're not licensed. There's admitted and then you're not admitted. It means you're some fly-by-night. So we like to use surplus lines. The problem, of course, is the statute uses non-admitted. So if somebody were to pull up the statute book, and they won't find surplus lines in there, they'll find the Surplus Lines Association in there, but they won't find surplus lines, they'll find non-admitted. And so you have to use both terms, particularly if you're testifying in front of the legislature or you're writing a white paper. But surplus lines, I think, is a more accurate description. Here's why. Surplus lines carriers are admitted somewhere. So they're just not admitted in California, but they have a license to write insurance in Delaware, in Nevada, somewhere else. So they are admitted somewhere. They're just not they're just not licensed in California. So in California, they're considered a surplus lines carrier. So that's really the main distinction. We can get into a lot of the particulars, but essentially, yeah, surplus lines simply means they're not licensed here. If you're licensed here, then you're subject to the full regulatory gamut of California. If you're licensed in Delaware but insuring California risks, you're subject to the full gamut of Delaware.
What are some reasons that a carrier would, and I guess this is loading the question, I'm assuming that they're choosing to not become admitted in California. What are some reasons that a carrier would make that choice to not obtain a license specifically in California?
Yeah, well, so the main reason right now is trying to get rate and form freedom. And, you're seeing that because of this Prop 103 intervener process, you could, if, for instance, I was just watching all these fast food restaurants because the minimum wage went up and they all increased their prices by 13%, 20% to cover that cost. Well, in insurance, you can't do that. You have to go to the Department of Insurance and say, hey, I can prove that I should charge more because now the wood I have to buy to replace your house and the nails and everything else has gone up and the workers are now making 13% more. I need to charge 13% more. And the department says, well, we have to have a hearing. There's an intervener process. And the interveners will come in and it'll be a year before you get that rate increase. So
maybe,
yeah, it could be 3 years. It's taken as long as 3 years. So if you really, if you're charging the right amount, which the department makes sure you're charging the lowest possible amount, is what it seems to, is typically what it is. You're not going to be profitable. And then if too many of your houses burn, it's like. Right now, there's several wildfires. They're pretty small. But, in the last in the 2000s, we've had 9 of the worst natural catastrophes in recorded history. So in the last 24 years, 9 of the 10, and the 10th one was Hurricane Andrew in 96. So, there's clearly more risk. There's clearly more stuff blowing down and burning and so forth. And the costs are going up. The inflation is a real thing, as we've all felt it, especially these last few years, and it affects the insurance industry. And so if you want to charge the right rate, you have to go surplus lines because you can't get the rate typically on an admitted basis, even though the department is trying really hard to give those rate increases. This Prop 103 intervener process just drags it out. By the time you get, 10%, it's 2 years later and you need another 10%.
Right. Interesting. I want to talk more about this. We have to take a quick break, but I want to touch on something you also said about rate and policy form, because there's some jargon I think might be helpful for some people.
Absolutely.
We'll talk about that in just 2 seconds.
Okay.
Let's talk about earthquakes for a minute. Look, we know we live in earthquake country here in California. Powerful, devastating earthquakes have happened here before, and science says that they will happen again. They can't tell us exactly when. They can just tell us that it is going to happen. Count on it. Prepare for it. Did you know that earthquakes are not covered by your homeowner's insurance policy? You need a separate policy to give you the peace of mind that you will be able to recover without getting financially wiped out the next time we get hit with a big one. There is a great company here in California that will provide you with earthquake coverage you need at a price you can afford. That company is GeoVera. I have a policy through GeoVera. I really like how easy it is to choose from all of their great coverage options, backed by the financial strength that lets me know that they will be here for me when I need them the most. Go to getquake.com/insurance hour to learn more. That's getquake.com/insurance hour. Make sure you're ready for the day when the ground shakes again. Hello, and welcome back. Karl Susman with Insurance Hour. Thank you so much for being here. Again, if you have any questions, you can reach us at 559-656-0317. If you miss any part of this show, you can always check it out on a podcast, check it out on iHeartMedia, check it out on Amazon Alexa, TuneIn, YouTube, you name it, we're pretty much everywhere. Today, we are very fortunate to have Benjamin McKay here, who is talking with us about surplus lines. Again, thank you so much for spending the time with us today. Right before the break, we were talking about why an insurance carrier would elect to be not admitted in a state. And you mentioned something about not being able to get adequate rates, and also about the ability or not to have certain policy forms. Can you explain a little bit about what you mean when you say policy forms?
Absolutely. And boy, I warned myself not to use jargon, and I did it right away in segment one.
It's part of our industry.
It is. Form is just the product, the policy. It's a contract between you and your insurer that they will, if some event happens, they will pay to make you whole, based on the terms, meaning the words that are in that policy. So when we say form, we just mean your insurance policy, the piece of paper that you get that promises that you'll be paid if some bad, unfortunate event happens. And so in surplus lines, most of the policies we call, there's another big word, bespoke, which means unique, right? It's each policy tends, in the admitted side, you'll have an HO3 policy, and everybody's homeowner's policy is pretty much the same. And
boilerplate is what most people look at it. Their policies are on a basic chassis, and then carriers will tweak them a little bit.
That's right, exactly. And there's this organization that's made up of insurance commissioners that looks at these policies and talks about the language and tries to make model laws. And then there's this group called ISO that creates ISO forms so that they're all standardized. But in surplus lines, we understand that some of these risks are unique. Not everybody has an antique car. Not everybody's building a building. And not every building is on a fault line. Some buildings are in a floodplain. And so the policies address those unique characteristics of the risk. You have fireproof tiles, or you have wood tiles, or you have for a roof, and the policy will reflect those differences. In a homeowner's policy, a distinction might be you have a fire hydrant right in front of your house, or you don't have a fire hydrant within 10 blocks of your house. Those sorts of things matter, and that insurance carriers will take that into account. And in surplus lines, it's very we're more specific about what the words say in the contract.
So is it fair to say that with the surplus policy, or with a surplus line insurer, they're able to be much more granular on what they underwrite for? For example, if somebody has a dog that's on the quote-unquote bad list, right, and the primary market says we don't want to insure your home because of the liability, because of that dog, a surplus carrier could come in and say, we are going to do everything. We're just not going to cover if this particular dog bites someone. They can get down to that level of granularity. Yeah, for sure. And I think the bad list is trampolines, pools, and dogs, right? And those tend to be we won't insure you list. And the dogs change. It used to be back when I was younger, it was Doberman Pinschers, right? And now it's pit bulls. And so which dog it is does change. But that's right. The surplus lines policies can get more granular. It takes more work to get more granular. They'd rather, have a more standard policy if they could, because it's quicker, it's more efficient. But with unique risks in the WUI, there's another term, the wildlife urban interface zone, that woodsy area kind of near urban areas. Those policies require some very specific examination we call underwriting, but you really want to look at how much defensible space is there. What is the chance that a fire is going to burn this house? When you do the math and you figure the average insurance policy in California is about $4,000, and the average house is about $500,000, which means you have to pay on that policy for 60 years before you've paid for the cost of that house. And so if you're an insurer, you can't have too many of those houses burned down, or you're gonna go out of business pretty quick. Right, and that's just the fire portion. We're not talking about a liability loss or something else that might happen and cost some money. So, the California marketplace, as everyone I'm sure that's paying attention realizes, is in crisis mode right now. So the surplus line carriers are really getting a lot of pressure put on them, both by market forces and by ironically, consumer groups to step in. I say that with a smile because it's usually the consumer groups that like to have a jaundiced eye toward the non-admitted market, and all of a sudden they've come around asking for help. So can you speak a little bit about how the surplus lines industry in general and the carriers have stepped up when it comes to property insurance in California since this insurance shortage has begun?
Yeah, absolutely. And that really is one of the key roles of the surplus lines industry, is to step in when the admitted standard market pulls back. So we're not allowed to write business that the admitted market is willing. We're not allowed to place business, insure houses, buildings that the admitted market is willing to insure. We specifically have to go to the admitted market, 3 different carriers who write a certain type of business, and ask them in writing and put it in an affidavit, a legal document that says, we swear we talked to 3 of these insurers and they said they wouldn't write this exact policy. Then we can write it. Then we can insure it. And so it's very, very specific. The law is very specific, and we're prohibited from writing it unless they don't want to. If they don't want to, we come in and we're able to insure it. Now, if we can't insure it, that's where the government part kicks in. But what you're seeing in the current marketplace is surplus lines is growing dramatically, hundreds of % over the last couple of years. Because of that pullback, as we've all seen in the news, all of these admitted insurers either pulling out of the state completely or stopping writing new business, and surplus lines has filled that gap largely. Now there's limits. If they pull back too much, we're really not a huge part of the market compared to the admitted market. So there's going to be capacity issues, even with lots of private equity, and lots of money is flowing to insurance, but the scope of the problem is so big that it still threatens to outstrip the capacity.
Well, that's the thing, right, is that there's still a finite amount of capacity out there, regardless of if they're admitted carriers or not. You mentioned something that I want to talk about right after our break, which is what has to be done before a consumer can actually purchase a policy from you, all of these affidavits and things. Let's talk about that as soon as we come right back. Benjamin, we'll be right back.
Perfect.
Ladies and gentlemen, boys and girls, in just a few moments, the Window to the Magic podcast show will begin.
My name is Patrick.
My name is Calvin.
I'm Mouseketeer Gray.
My name is Paul, and I will be your guide through the wonderful world of Disney sound experiences.
This show is a weekly trip into the world of the Disney theme parks and resorts.
And this is the place where you get to use your ears to surround yourself with the magic.
For your safety, please remain seated while listening to the windowtothemagic.com podcast.
Maybe there's a name for this, something like Disnotic obsession. Please visit windowtothemagic.com for more information, or you can find us on Apple Podcasts and in the iHeartMedia app.
Hello, and welcome back. I'm Karl Susman, and this is Insurance Hour. Thank you so much for being here. We are talking about surplus lines insurance with Ben McKay, and I want to just jump right back in. We have so much to cover. Right before the break, we were talking about some of the I guess you could call it red tape, some of the processes that have to happen before a California consumer can actually buy from a non-admitted company. It's interesting because I always think about buying cars. I can go buy whatever car I want. There's no stoppage. There's no law that says you can't do this, you can't do that. There are no hoops I have to jump through. But interestingly enough, if you want to purchase insurance from a particular insurance company, there are steps you have to go through as a consumer. And as we're going to hear now, also steps that the insurer has to go through before the two of you can actually be paired together. Ben, you want to walk us through that process?
Absolutely. So if you can't, let's use homeowners as the example. If you want to buy homeowners insurance and your agent, your Karl Susman, can't find an admitted carrier, say, State Farm, Allstate, any of these carriers that are no longer writing in California, you then can go to the surplus lines market, but only after you ask 3 of those carriers, admitted carriers, who write that type of business. So you can't go to a carrier that doesn't write homeowners and say, hey, will you write this homeowners policy? We know you only do auto, so say no, and then I can go to the surplus lines marketplace. It has to be a carrier that writes that kind of insurance, that, houses, within the range of your house, 100,000 to 500,000, whatever it is. And you have to then fill out an SL2 form, newly designed SL2 form, which is a legal affidavit. And you have to put down the name of that carrier, the phone number, who you talked to, so that it can be verified that you actually did talk to. Now, you as an individual aren't going to do this. Your agent's going to do this for you.
Right. I was waiting for a break to be able to ask you the burning question. You're saying you have to go to 3 places.
Yeah.
Consumers don't have to call 3 places. If they're dealing with an independent broker, this is something that they have to do sort of on the back end.
Correct. Now, if you're not dealing with a broker, you would have to, you would have to do this yourself. But you're probably not doing that, I would guess. You also have to file, the retail agent has to file D1, which is this disclosure form that essentially makes sure that this is a surplus lines policy, and then they have to maintain that in their records. So there's some paperwork, and then you have to go find the surplus lines carrier, and that can be challenging because they're not household names. People haven't heard of Lexington and Ironshore and these carriers because they're really known to surplus lines brokers who place business with them because they're not allowed to advertise. So you're not hearing about them.
That's an interesting one right there. I want to pause you on that. So you're saying that if a carrier is not admitted to do business in California, they can't place ads on television?
That's right. That's why you'll never see a Lexington commercial in California, and so that's the other reason they're a little bit tricky to find, and why you need your agent to go either direct or work with a surplus lines broker to find carriers who A exist and B will insure your particular kind of risk, and it really gets complicated or funny. Complicated, I think people turn their brains off. So let me erase. Not complicated. It gets interesting because if you're an insurance carrier admitted in, say, Nevada, Florida, Texas, somewhere else, you're considered a foreign insurer to a California insurance consumer. So you're foreign, even though you're still in the United States. We consider you foreign. You're foreign to California. If you're located outside of the United States, so you're in Japan, you're in Switzerland, then you're considered an alien. So
I'm laughing because you and I know these terms, and it's funny when you say them because they're so poorly
chosen,
defined, right?
Yes.
But yeah, they're aliens.
Yeah, they're aliens, and of course, in the modern political context, it's even worse, right, to call them aliens. But when you go to your insured and you say, "Hey, I had to place your insurance policy with an alien," they're going to look at you funny. Say, I don't want my policy placed with an alien. I don't know how to get to Mars to collect on that policy. But those are the terms that have been in place for years and years, decades, if not centuries. And so those are the terms that are used in the statute. So we use them again, just like we have to make sure, even though surplus lines is better, we talk about non-admitted because it's the term of art and it's in the statute. So that's.
Would you say that it's fair to say that one of the reasons that we don't see, we're not recognizing some of these non-admitted carriers is specifically because of regulation that prevents them from marketing? So we simply aren't exposed to them. Is that a fair statement?
I think that's a very fair statement. Yeah.
And is it true that there are some companies, non-admitted companies, that are actually owned by or are subsidiaries of admitted companies or names that we might be familiar with?
Absolutely. In fact,
tell us about that.
Yeah. So basically, all of the carriers, Liberty Mutual, Travelers, Nationwide, they all have surplus lines carriers in their group. So it'll be the Nationwide group, and they'll have admitted carriers and they'll have surplus lines carriers in that group. And in fact, if you want to take a nice trip to London and you go to Lloyd's of London, they have these they call them boxes. They're just groups of desks where different insurance carriers, they call them syndicates there, different syndicates set up. And if you went there 100 years ago, you might see the Ben McKay syndicate or the Karl Susman syndicate. If you go there today, it's Travelers. You see the Travelers umbrella. You see the Liberty Mutual statue. It's all the ones that you see that you're barraged by on TV constantly. They're all the syndicates now. So yes, it's a really good point. It ends up, with a few exceptions, it ends up being all of these behemoth insurance companies. That in some, I'll give you an example. Progressive set up a surplus lines insurer to insure Uber. It's a very unique type of risk. This transportation network company is what we call Uber in statute. It's a very unique risk because you have the app and how much are they insured for when the app's on, and then versus when someone's in the car versus when they're cruising around looking for somebody. There's different insurance limits for each of those three stages. And so they had to set up a special purpose company to insure that risk. And it's certainly been challenging. They weren't the first one to insure Uber. But
it's interesting because, like you said, and I want to talk about this more right after the break, these are owned by companies that we do know. Let's talk about it a little bit more as soon as we come right back. Ben, stand by.
Got it.
Do you need homeowners insurance? Has your previous insurance company left the state, non-renewed your policy, or maybe they just raised your premium to an amount that you simply can't afford? Whatever the situation, we can help. Just dial pound 250 on your cell phone and say keyword insurance quote, and we will connect you with an agent who can assist you right away. Or if you prefer, you can visit us online at insurancehour.com/quotes. Whether you're looking for homeowners insurance or auto insurance, we'll send the best options straight to you. So, what are you waiting for? Simply dial pound 250 and say keyword insurance quote, and we will connect you with a live agent to help provide competitive quotes for your homeowner's insurance or auto insurance. Don't get caught unprepared. Insure what matters with an insurance company you can trust and with a premium that you can afford. Don't put off until tomorrow what you should have done yesterday. Simply dial pound 250 on your cell phone and say keyword insurance quote.
Hello. Welcome back. This is Karl Susman, and you are tuned into Insurance Hour. If you have any questions, feel free to reach out, of course, anytime, 559-656-0317, or you can send your questions to questions@insurancehour.com. Any immediate questions or concerns, you can dial pound 250 from any mobile phone, use the keyword insurance, and get connected to an agent that can help you right away. Today we have our special guest, Ben McKay, and he is helping us understand the surplus/non-admitted insurance marketplace. I have to get the wording just right?
Yes.
And before the break, we were talking about carriers that are non-admitted actually being owned by carriers that are and that we might recognize. Ben, you wanted to explain how that works and how that would potentially be an area that consumers should be aware of?
Yeah, so it's really corporate law. So you can have many legal entities under the same corporate umbrella. So if you're Liberty Mutual, it's not just one company. It's 10 companies or 20 companies. If you're Nationwide, the same. If you're Berkshire Hathaway, you're an insurance company, you're a railroad, you're an investment company, you're Geico. It doesn't even have to all be the same business. It could be completely diversified, and that's pretty typical in corporate America these days. And so you might be dealing with a surplus lines insurer, but that surplus lines insurer very well could be owned and probably is owned by an admitted carrier, or more and more owned by private equity groups, which are all the rage in the last decade or so, buying all kinds of businesses and recently getting into the insurance space.
Let's talk a little bit about how we can subdivide certain carriers that are non-admitted in California with the lessee list. I get a lot of questions from people that say, do I know if this is a good company? Do they have enough money? Has anybody checked them out if they're not admitted in California? Can you explain the Leslie list, how it works, what type of background checking, if you're comfortable saying that the Department of Insurance does, and what a general consumer should be able to take away from that?
Absolutely. So the Leslie list is the list of approved surplus lines insurers. So here we go, mixing terms again. Surplus lines, not non-admitted. But so the list of approved surplus lines insurers is a list that is owned by the department, but most of the research is done by us at the Surplus Lines Association. And carriers who want to be on the list, it's a voluntary list, they have to submit to us proof of financial stability, proof of seasoning, that their management team has been in the insurance business for a sufficient amount of time, usually at least 3 years, that they've done this kind of business that they're looking to write, whether it's homeowners or construction or whatever it is, that they have expertise in that. And they submit all of this documentation to us. We review it, and we have a whole team of financial analysts that will look at not only the management, but how their capital is kept. Is their capital, so for instance, in California, you have to have $45 million in capital in surplus or the equivalent. And there's buckets. So 20 million has to be very, very safe. In other words, like treasuries, it has to be, you can't lose that money. And then the next 20 can be a little bit more, a little bit less solid. It can be, for instance, like securities, but it has to be AAA rated, versus, credit default swaps.
And just to reiterate, you're talking about how an insurance carrier is maintaining their reserves, the money they keep on hand.
Correct. The money they have on hand. Now, and to compare that to an admitted carrier or a licensed carrier, they need about $1 million in paid-in capital and about $2.6 million in surplus. And that's about it. And
why the discrepancy?
Because the department, the belief is, or the public policy is that they're more heavily scrutinized by the department. So, and that number goes up, by the way, as they write policies. That amount that they have to keep in reserve increases. So that what I'm talking about is just the sort of table stakes, just to hang a shingle and say, we're Ben McKay Insurance Company, licensed in California. The numbers are much less. So the public policy is they're more heavily scrutinized, so they don't need as much money because they're watched constantly. There's market conduct examinations, et cetera. In reality, there was this crisis a few years ago, and this housing crisis, and there was legislation that came out of it called the Dodd-Frank Act in 2015. And in that legislation, there was a section that addressed surplus lines insurance and essentially said that there's a minimum, surplus lines insurers can write in any state where they meet certain minimum requirements, which essentially are they're admitted somewhere, so they're licensed in another jurisdiction, and they have 15 million in capital or surplus. But it also permitted, so this is a federal law, it permitted states to increase that minimum. And California chose to increase it from 15 to 45. So,
I'm shocked at that.
Yeah.
Okay.
Yeah. So that's really why it was really just, it came out in the legal wranglings, what feels right at the time in 2015, what number, and then 2016 in California, what amount feels safe for consumers. And that's the number we landed on. They call it, law and sausages, the two things you don't want to see made because it's just so nauseating. This is an example. It's just that sometimes there's not a ton of rhyme or reason. It's just kind of your best, the policymaker's best effort.
So it's fair for someone to say that if they're going to purchase insurance from a non-admitted company, that it's a reasonable ask to ask your broker if they're on the Leslie list, or is that a list that they can just go and look up themselves online and check themselves?
They can absolutely check it online. It's on the surplus lines, slacal.com. It's on our website. Just type LASLI and Leslie list, and it'll come up. It's also on the Department of Insurance, the CDI.gov website, and you can see it there. highly recommended. You don't have to be on the LASLI list to insure risks in California, but if you're not on the LASLI list, there's no telling what your actual financial situation is. It could be fine. It could not be fine. An example that a regulator told me one time was there was a company that claimed to have $15 million worth of olive oil. And that was one of their assets. And they had one of those giant containers you see on the side of the road that you think are filled with gas. And an inspector actually went up and climbed up the stairs all the way around and opened the big hatch, open the hatch and stuck a stick in, and the stick went down about 6 inches.
Ben, hold that thought. We got to talk more about olive oil. We got to take a quick break.
Ladies and gentlemen, boys and girls, in just a few moments, the Window to the Magic podcast show will begin.
My name is Patrick.
My name is Calvin.
I'm Mouseketeer Gray.
My name is Paul, and I will be your guide through the wonderful world of Disney sound experiences.
This show is a weekly trip into the world of the Disney theme parks and resorts.
And this is the place where you get to use your ears to surround yourself with the magic.
For your safety, please remain seated while listening to the windowtothemagic.com podcast.
Maybe there's a name for this, something like Disnotic obsession. Please visit windowtothemagic.com for more information, or you can find us on Apple Podcasts and in the iHeartMedia app.
Hello. This is Karl Susman, and you are tuned into Insurance Hour. Thank you so much for spending time with us today. We are learning all about non-admitted insurance companies, a.k.a. surplus lines insurance carriers, a.k.a. olive oil. I think that's going to be a new one. Ben McKay is our special guest. Before the break, we were talking, and again, if you've missed any of this, be sure to go back online and find us. Just search for Insurance Hour. You'll find it as a podcast. You'll find it on YouTube. You'll find it everywhere. Ben was explaining how different insurance carriers maintain their money, basically, their funds, and he was talking about a very interesting one. Ben, start that one over again. I want to hear it again.
Well, so assets are assets, and they could be anything, gold bars, or in one case, olive oil. And this company claimed to have $15 million worth of olive oil in this giant tank. And an inspector went out and climbed up the giant tank and opened the hatch and stuck a stick down, and the stick went 6 inches down. So, they had, a few $1,000s worth of, although today, I don't know, maybe it would be $1 million worth of olive oil, but it certainly wasn't $15 million that they had claimed. And so companies that aren't reviewed, that aren't on the LASLI list, aren't reviewed by us, reviewed by the Department of Insurance, you never really know. And when something bad happens, like a giant wildfire that wipes, the one in Paradise, for instance, that horrific event, an insurance carrier just folded immediately. As soon as that fire, probably before the fire was even put out, they went out of business. They handed the keys to the building, to the department. So you want to make sure that, not only do you have insurance, but you have insurance with a carrier that's going to be able to pay that claim, right? Because that's ultimately what we're selling. We're selling a promise, and that promise is that we'll be able to pay that claim when the bad event happens, so that you'll be made whole. And so if you go with an insurance carrier that's not financially secure, that promise may be broken.
And so you're saying that this list is something people should definitely check out, and relatively speaking, that is a level of oversight that's being done that might not be necessarily by the Department of Insurance, or includes them, or what's their involvement in that? Yeah,
it's their list. They have final say on what carriers go on that list. So we review them, they review them. So it is absolutely a level of oversight. The list of approved surplus lines insurers. Carriers want to be on it because it's essentially the good housekeeping seal of approval. It says that they've gone through the scrutiny, they've gone through the financial review crucible, and they came out the other side successful. And they have the money they say they have. They're being watched. It's not just a one-time deal. We review them on an ongoing basis. So it's certainly a level of certainty that an insured can have, that the promise is going to be kept.
Do you have to date us by saying good housekeeping?
Did I?
Anyone that's going to get that reference, like you and I, all of a sudden I'm thinking, oh, my sciatica. Oh, there's something. I don't. Good housekeeping seal of approval, but maybe we'll call it the Better Business Bureau. That's a little more. That feels a little more current, right?
Go back and edit that out.
Yeah, we'll try and we'll just pretend we didn't hear that. So if now that we've covered the general idea that a non-admitted carrier or surplus lines carrier, number one, might be a carrier that you know of, in a different. By a different name. Number two, there is a way that you can even check on these carriers by the California Department of Insurance and others to be sure that they have the financial wherewithal to be taking on the risks that they do. Yep. So we understand that. Now talk to us about the process, how it differs for a consumer. If a consumer is going to a broker